Greetings. This is the first in a series of video Friedman's comments. Friedman's comments started, depending on how you count back, in about 1999. First in a written email newsletter that got sent out to people, and then there was a while I sent them out via PDF files and emails, and now here in 2008 it's going to be video. The idea here is to, every once in a while, when something is very much on my mind and other people's minds, do a quick video, minutes, 2, 3, maybe 5, the way things go it could be more, but hopefully 5 minutes or less, or fewer, about that question that's on people's minds. So today is the 17th of April, 2008. Taxes are not on people's minds. They stopped being on people's minds about 2 days ago. Instead, what is on people's minds is the financial mess that's been going on pretty much since about August, I would date it to. In August, there was a day where the jumbo mortgage market pretty much froze up. And the way mortgage people would put this is that the GSEs, the non-GSE, mortgage origination process stopped dead in its tracks, just froze up. GSEs are government-sponsored entities, Fannie Mae and Freddie Mac. I think that's what it stands for. And what had happened was lots of financial intermediaries had stepped into this jumbo mortgage market, which was any mortgage above $417,500. Was the kind of mortgage that the GSEs would not buy, not stand in back of. So there was this whole huge financial machinery that had gotten more and more momentum behind it over the last several years, and basically got all the money that was funding these big mortgages by syndicating the sale of mortgage packages to all sorts of folks. You know, could be anyone from hedge funds to, as we now know, most of the financial center banks, probably some governments were buying them, just everything, pension plans were buying these mortgage-backed securities. And the music stopped. It was in every way imaginable except for the people involved. It was like a cakewalk at the county fair where the music stopped and everyone scrambled, and basically a lot of people got stuck holding the bag on all of these packages of big mortgages. So that figuratively blew up on some evening in August. August 24th comes to mind. That's probably not the right day, but somewhere around there. And what's transpired in the last roughly 8 months now is slowly but surely more and more shoes have dropped. And we saw a really scary January stock market, basically down 8 to 10%, depending on how you count, all in 1 month. And so people are pretty scared about this. So I had one person ask me about, very specifically, about this mortgage mess and about how the mortgage obligations, I was going to say obligors, but let's keep this simpler. The people who are holding the mortgages at this point, those of you who have mortgages know that you probably are not paying the same people that you were paying when you first started the mortgage. It's been sold. Are so far removed from the people who are paying the mortgages that there's no way any rationality can come to this unwinding process as people get foreclosed upon, et cetera, et cetera. I think there's a lot of truth in that. The people making decisions about what is acceptable workouts of a mortgage are pretty far removed from the initial banking relationship, such as it was. I'll bring that point back in a second. And then I'm also hearing people saying, my portfolio has just decreased and decreased and decreased for months on end now. And in fact, I think the statistic is since August, the stock market has gone down every month, with April, we're right in the middle of it right now, of 2008, looking like maybe we'll have a decent month where it doesn't go down. So what to do about that? I actually heard somebody say, I regret that I didn't take all my money out of the stock market in the past, and now I'm going to, and I'm going to invest it in basically money market savings accounts. What do I have to say to that? Well, if the winds of woe are enough to make you want to get out entirely, then you probably shouldn't have been in the first place. Anyone who helps anyone get into the stock market, something I do, has to really, really discuss with people the fact that the stock market goes like this. It goes up and down a lot. And the price that you pay for having really, over the course of decades, really beautiful returns, historically speaking, in the range of, say, 8 to 10% per year over the long run. The price you pay for that is the stomach-churning, random, arbitrary, and capricious changes in prices. So the last thing you want to do is put money that you need soon into the stock market, because the price you're paying is, it could be $1.10, or it could be 90 cents, it could be $1.20, it could be 80 cents. Not a good place to hold money that you think you're going to be tapping into anytime soon. Instead, that should be in cash or bonds. Now, this person who wanted to get entirely out of the stock market and put it into cash, that's a little bit better than what a lot of people do, which is they get entirely out of the stock market and put it into bonds. So right now, bonds are yielding 2, 3, maybe 4%, depending on how much risk you want to take. Which means, without going into details about how interest rates move in the opposite direction of prices, since interest rates are really low, that means that bond prices are really high. So what that, in general. So what that means is, as the stock market has cratered, this one person, who I heard about, was actually taking the money out of the stock market right when the stocks were low and putting it in the bond market right when the bond prices were high. So the classic of selling low, buying high. I had to stop and think, because it's so contrary to what you want to do. You want to buy low and sell high. Duh hey, right? So this all boils down to one of my favorite sayings about all of this, which is, the fewer decisions you make as an investor, the odds are the better you're going to do. So that doesn't mean you can't think about it, but what it does mean is a well-designed investment plan. Number one, it's written down, and number two is something that involves a lot of decisions up front and then very few decisions later on. So you might set up, a series of decisions at the front end, and then once a year you might review those decisions. And if you are antsy, you should talk to who's ever helping you do that. If you're doing it on your own, talk to yourself, read what you wrote down, and figure out if this is something that's really out of the ordinary or not. So let me talk about what's out of the ordinary.